Welcome back everyone to exam.com and to this technical analysis video for Wednesday, January 26th. I'm Christina Bartanidu, investment analyst. Take a look at the euro versus the Japanese yen on the daily chart. So having a look at the chart, we can see that the pair is consolidating its 3-week sell-off over the past few days within the narrow restrictive zone between 128.80 and 128.58. Of course, the price exited that region yesterday to post a new 1-month low at 128.23, but then the price returned to that tight region. And the question here is this a make or break point, or otherwise is the sell-off losing its strength and it's time for some recovery? Well, if we look at the momentum indicators, the stochastics seem to have found a bottom in the oversold territory. They have already resumed their positive slope, but are still below 20. That's the only encouraging sign, because if you look at the RSI, the MACD, those indicators are still trending downwards within the bearish area. And if we look at the Ichimoku lines closely, the red Tenkan-sen line has recently crossed below the blue Kenju-sen. So overall, we can say that the bias is bearish, and the base scenario is for the pair to keep weakening. But for that to happen, the price will need to step below the 128.58 level, in which case the decline could initially pose near the 127.90 barrier from last August and September. Before we see another test at the bottom of this down leg at 127.48. Now, if the sell-off extends below 127, then the next stop could be somewhere 126.20, 125.80. That was last active at the end of 2020 and start of 2021. Turning to the bullish scenario now, where the price closes above the resistance of 128.80, which is also the 23.6% Fibonacci tracement of the downleg from 133.47 and 127.48. Then I expect the price to keep strengthening towards the 50-day moving average at 129.28 currently. If that proves weak to break, then the focus will turn to the 38.2% Fibonacci of 129.70. Above that, the 50% Fibonacci of 130.42, which is close to the flattening 200-day moving average, could also block the way. However, if we manage to breach all this obstacle, there is another big challenge around this descending trend line over here. So what could be more meaningful for the market is a decisive close above that line, which is currently around 131, and more importantly, a close sustainable move above the 131.35 and the 61.8% Fibonacci of 131.53 could be an even stronger bullish signal for the market, and that could weaken fears that this negative trajectory over here could be something more than temporary. So overall, the short-term risk is still skewed to the downside, and I suspect the downside move to continue, but we will need a break below 128.58 to confirm that. So that's everything I wanted to share with you. Thank you for watching and have a great day.